Hey, here's just a quick overview on options before we discuss it, so you have an understanding of how options are priced and how volatility has an impact on it, and how the underlying stock price has another uh, very big impact on it. So I'm going to quickly just bring over a really simple screen so we can do it. Nothing. I didn't build anything pretty. It's just bare bones. So option trading, why do you do it? Because of leverage, which means smaller upfront dollars, but potential for exponential profit. In your case, you lucked out, or a huge loss. All right. So just watch as huge loss as well. All right. And we'll go through it, why you're so successful now, and why, if it flattens out, this could happen. So just be careful. So how are options priced? Call options, where you are the buyer, which I think that's what you're doing, is buying call options, and that's considered calling. It's coined long the option. So you're long, meaning you expect it to go up in the long term. All right. And so how are they priced? So a call option is priced based on the current value of the underlying stock. So AMC closed Friday at 47.91 a share. Then you pick a strike price. In my example today, it's going to be $95. So the idea is to get your $47 as close to 95 or above as quickly as possible, and you keep making money if that takes place. If it goes the other direction and AMC goes down in price, then the farther away it gets from $95, the less you make. In fact, the case you might lose. All right, time to expiration. In my example, I'm taking June 25th because it's close. There's 19 days. So the longer the number of days, it costs you more to buy that option, but gives you plenty of time to try to get $47 to meet or exceed the $95. All right. And then finally, another huge component, which is probably the most important, is implied volatility. And with something like AMC, volatility is through the roof. All right. And that's why that volatility is making you a ton of money. Um, and we'll go over that. The other two components are risk-free rate of return and dividend yield. And in this case, these things mean absolutely nothing for today's quick overview. By the way, anything I'm saying here is educational only. I'm not saying to do this stuff. You do it on your own. Yeah, just if you feel like doing it, you do it. If you don't, this is just to try to give you an understanding of how this stuff works. All right. So again, this is what we're going to do. Value of the underlying stock, what strike price you pick, how many days you have till expiration, and really the killer, the creme de la creme, is implied volatility. All right, enough of that. All right, so now we're going to go to this is called Thinkorswim. You're probably using Robinhood or some other platform, but this is Thinkorswim platform. And so I picked AMC, obviously, as the stock. This is the last price as of Friday afternoon. All right, 47.91, and these are the option chains right here. Um, so I said we're going to pick. There's a couple of option chains before the 25th of June, but I'm picking the one with 19 days left. It's a short amount of time, so we can get a few more examples in, but at the same time, it's close enough to watch it. Uh, so that's part of our criteria: underlying price of the stock, expiration date. All right, 19 days. One of the other key things, we're going to talk about strike price when we get in there, when I said $95, but not until I open it. But you can see here, here's implied volatility. So at the highest level for the 19th of June, 387% is the average implied volatility for all the strike prices. But as I explode this open and we go to $95, which is right in the middle here, this strike price here, as I go to $95, you can see that implied volatility on the 95 strike is 495%, not 387. So the higher the volatility, the more you're going to pay for it. But if it goes up, it's going to boost the ask price and the bid price higher. So again, when you're buying a call option, you're buying the call at ask price or somewhere in between, however you want to do it. But in reality, if you want it to execute immediately, you type in the $10.50, times for one contract times 100. If you're going to sell it, so this is the spread, 10.50 you buy it for, 10.05 you can sell it immediately. So you take obviously a 45-cent loss times 100. All right. But the key thing here, for this example, it's really 495% versus the overall average of 387. Just to put in perspective, let's go back here real quick. I don't want to waste a whole lot of time on this. So anyway, so that's AMC. Let's take J&J, a typical blue chip stock, and you can see that implied volatility is 18%, 20% as you go out. And then finally, let's take the S&P 500. The S&P 500 right now is really low volatility in the market, and you can see 9%, 11%. So these, obviously, you're not going to make a ton of money on these guys because implied volatility is so mellow that there's not a whole lot to do there. All right. Let me just go back up to AMC. AMC. All right, so we're here. And now we're going to go to the 19-day, and we're going to go to the 95 strike price. So I'm just scrolling down, 95 strike price. All right, so we're right here. So they're calculating $10.50 if you wanted to buy it as of this moment while the market's closed. I don't know what it will be. I don't know what it will be on Monday morning when it opens, but for right now, it's $10.50. So here's a spreadsheet I built a few years ago to try to demystify this whole thing. So what we have here is we want to put in the underlying, here's the stock. And so we're going to put in 47.91. All right, we're going to put implied volatility of 495%. We have 19 days left. And we have a strike price of $95. And risk-free rate of return I have is 1%. I told you it doesn't really matter for this example. Dividend yield of 1%. It doesn't matter for this example. So my calculation comes out, the value of that call option should be $10.64. The market right now, with it being closed, is saying $10.50. So we're close enough, all right, for our example. So I'm going to show you what happens. First thing, let's do the positive, and let's say that you buy it, and during the course of the day, the stock price goes up to $120. And so then your $10.61 is now worth $57. That's perfect, right? Yeah. Now we go back down. So I just unmodified it and went back to the original. So that's if price goes up. That's great. So let's take a look at implied volatility. If that goes up, let's say some news comes out and there's some takeover or some other crap that goes on. Let's bring that up to 800%. Now watch the 1064 again. It goes up to 18, so you're up 80%. And let's do a combination. So implied volatility went up. This thing went up to $110. Now you're up to $62 a share. So your $10 that you paid for it is now worth $62. All right. So we'll go back, and I'm just going to back out of both of those. And so we're back down to 1064. So that's the upside. So if implied volatility goes through the roof, you make money. If the stock price meets or exceeds the strike price before the expiration date, you make more money. All right, so that's one way to make money. And in this game, since if you're watching Wall Street Bets, everyone's in collusion. I know they won't say it. They'll say they're retards and they don't know what they're doing. But let's put it this way. Everyone's colluding to try to squeeze the shorts. And in doing so, they're creating a lot of volatility and trying to get this stock to move because they buy in tandem. And obviously, they're going to keep trying to boost this up and squeeze the shorts out. All right. So anyway, that's if it goes up. If it goes down, let's just take a typical example where nothing moves. Let's say the stock price stays around 47, implied volatility doesn't change. But day by day, this thing goes down to 18 days. Now watch this down here. 18 days. It just went down to 1014. 17 days. 16 days. And it erodes day by day. If nothing else changes, it erodes. We go down to 5 days. Oops, don't want that. We go down to 5 days, and it's worth $2.12. So again, if nothing else changes in your favor, implied volatility going up or the stock price meeting or exceeding the strike price, days wither away and you lose money. All right, and eventually, when you get to day one, your investment is worth 2 cents. All right, so you walk away as a loser. In this world where it's being fabricated, this would be typical if you were to do a stock option on J&J. This would normally what happen. Usually buyers or people that are long a call option lose money because it expires worthless. But in your case, the fact there's probably 3 million people trying to squeeze the shorts, you have that as an advantage. All right, so let's put that back to 19 days. So those are really the fundamentals. But let's say we have 19 days, and instead of $47.91 a share, let's say it drops down at 30 some morning. All right, some shit hits the fan, and because you went farther away from the strike price, your $10.61 investment is now only worth 382, even though volatility is the same, even though there's 19 days left. All right. Now let's take it another way. Let's drop volatility. So let's take volatility and say everything else is the same. Price stays the same, 19 days left, but some news comes out that some rumor comes out that all the shorts are out of the market. There's nobody else to squeeze, and this thing goes down to a number like J&J has, 21%, and boom, your option's worth nothing. So even though you have 19 days left, even though the underlying stock still worth $47, you have nothing left of value. All right. So that's how this whole thing works. Just keep that in mind, play it over and over again, realize that a lot of money to be made if implied volatility goes up. The beauty of this would have been, and probably what you did the first time is you probably bought it when volatility was, let's say you bought it here. All right. Let's say you bought volatility when it was at 50. All right. That's not going to work. You know what I'm saying. If you bought it with low volatility and the volatility shot up to 495, you're going to make a whole lot of money. All right. So that's it. I figured if you watch this and you get an understanding of how all these different levers work, either in your favor or against you, any questions you might have would be probably easier to talk about with some basic understanding of this. All right. Talk to you either Tuesday or Wednesday, whichever fits in for both of us. All right.